Hi, this is Michael Fisher for SavingAndInvesting.com, and I want to speak briefly about closed-ended funds. When we speak about mutual funds, we're talking about open-ended funds. And mutual funds, open-ended mutual funds, are funds that can take in money on a continuous basis from many different investors, some small, some larger, including private individuals, and then where the money is pooled and then invested in a certain category of assets or type of assets as defined by the characteristics, the literature, the prospectus of the mutual fund, to some extent its name, but most definitely its prospectus, and also which has a benchmark against which the performance then of that mutual fund is measured. There is such a thing that is called a closed-ended fund, and sometimes even referred to as a closed-ended mutual fund, even though it's not really a mutual fund at all, in the sense that it's more like a company that issues shares for a limited time and issues these shares to raise capital, after which time it is no longer possible for that fund to take in money. So basically, instead of being a pool of assets that grows and shrinks with the amount of money that individual investors and institutional investors put into it, a closed-ended fund is a fund which raises capital over a limited time period by issuing shares typically and often being listed on a stock exchange, and then having that money that was raised during that capital raising exercise also as a pool of money, and then investing that pool of money somewhat similarly to how a mutual fund would, i.e. potentially in equities or in other investments or in bonds even, on behalf of the individual investors or shareholders, in this case, of the fund. What makes a closed-ended fund different is that investors can go in almost on a continuous basis, because especially if it trades on a stock exchange, meaning that all day long one could buy shares in the fund and become an investor in the fund. Whereas in a mutual fund, typically that happens once a day, but that's not really a limiting factor, because once a day is frequent enough when one really has to have a long-term time horizon with these types of investments, mutual funds anyway. But they trade like shares on a stock exchange, so that's one important difference. And because they are shares, they can trade at a discount or at a premium to the value of the assets that each share represents, because the price is more determined by supply and demand in the market and not just the value of the underlying assets in the fund. Furthermore, why would a fund management company prefer to use a closed-ended fund over an open-ended fund? Typically that would be the case because a closed-ended fund would allow the fund management company to retain the capital once it's raised. In a typical mutual fund, if investors are unhappy with performance, or if there are other investments which seem more attractive, or the investors feel are more attractive, they can withdraw their money out of the mutual fund very quickly. In a closed-ended fund, the capital is effectively captive. Although an individual investor can get out by selling his share, the money that the fund company raised is captive, because that money, when they sell the share, that share is going to someone else, and it's not the fund management company that gives the money back to the individual investor, as is the case with a typical mutual fund. So a closed-ended fund would be a valid structure, for example, in the case where a fund management company was aiming to invest in assets where the time horizon for investment would be much longer and where it would be difficult to sell the assets to raise cash when an investor wanted out. For example, in an S&P 500 mutual fund, if an individual investor wanted to redeem and get out, the fund management company can just sell the shares that individual's investment represents and give him back his money, or give him or her back their money. In the case of a closed-ended fund, or if the investments were in less liquid investments, then it would be difficult to sell those illiquid investments to give the investor back the money, and therefore it may be advantageous to use a closed-ended structure. It should be said that closed-ended funds are much less common, and that when we talk about mutual funds and all the sections on mutual funds, those refer, of course, to open-ended mutual funds. But I just wanted to describe briefly what a closed-ended fund, or what even sometimes is referred to as a closed-ended mutual fund, is.